So let's just get started. I'm going to start this off and make sure the point of this entire video is that there will be no recession. That is, you guys hear me say it. There's no such thing as recessions anymore. But I'm going to go through this and make you realize how important it is if you can get to that point, because it'll be the place that puts the bottom in. The tariff chaos continues. Although we kind of reached a point where I think we went from bearish to the panic stage. The hedge fund deleveraging continues, but there's some signs that at least for the U.S. market neutral equity side, it looks like it's reached a point of at least short-term bottom. I'm going to go through Ray Dalio, kind of direct you guys towards why the tariff plan for me is getting clearer. There seems to be a playbook here that's been released, and I think it's important to spend time on it because it'll go back to why I don't think there will be a recession, because I don't think they can afford it. Important bullish AI signs. There's some stuff happening that I've been watching related to some companies that I think, and some prices that I think are incredibly important for this year from a structural basis. And then we'll go through AI, humanoids, and Bitcoin. So in terms of the recession, it started off with Trump giving an interview on Sunday and basically saying, I hate to predict things, so he wouldn't say there wouldn't be a recession. We've got the gyrations continuing, and people are starting to realize, especially after the 200% wine comment, that anything he says on this, he can make the stock market go down, and it seems like he doesn't want the stock market to go higher, so it'll probably have a hard time sustaining any rally until he's done negotiating. I'm not going to bend at all, just refuses to give in. This is the 200%. Basically, anyone who attacks him on the tariff side, he comes back and just increases the number by sometimes 2 times, sometimes 4 times, whatever the case is. We're just in this point of clearly using social media to keep the tariffs going. Whether U.S. is heading for recession or just a decog down, I'm just going to go through the stories of what went on this week in terms of people getting more and more scared. We did see stocks basically cut guidance on the back of the fact that they're seeing people pull back on spending. Anyone who didn't believe this was going to impact the economy, and there were a lot of people last weekend even who reached out after I sent out the email on my video that said they didn't see any weakness in the consumer. They don't see how this is weak. Anyone who doesn't see the impact that this is having and doesn't realize we live in a polarized economy, everyone who didn't vote for Trump absolutely believes the economy is headed downward. And you see this in stuff like this. The UMich data, which comes out, when you break it down by parties, which I'll go through later, you start to see numbers like this. This is important data in terms of overlays. This is from Renaissance Macro and Jeff DeGraff, basically showing how in the recent numbers, this is the 1-month payroll change, meaning the gray lines here. So this is where we are right now. And this is the drop-off that we've seen in terms of consumer sentiment on unemployment during the next year. So people believe there's going to be a recession in at least a high majority of people in the UMich survey. Larry Summers came out, said 50%. I wonder if they'll start putting tariffs will raise the probability of no recession to around 65% instead of trying to continue to get people all freaked out. BMW talked about earnings hits from the tariffs as this spread. Bundesbank warned that the U.S. tariffs could put Germany into a recession. Bill Dudley, who seems to really hate all of Trump's policies, former New York Fed governor, basically said these tariffs will be worse than the markets thinks, and I'll go through some of that. But he basically went through and said puts the Fed in an impossible position where they won't be able to lower rates because of the inflation staying higher while growth slows. The reason we are seeing the consumer, you can see this on here, we've got a spike going on in recession everywhere we look. This is not just something that is made up. People are scared. Delta on that guidance, we saw companies start to pull back on corporate spending and consumer spending start to stall. Remember that I showed this last week, and this is from Apollo and Torsten Schlock, who put this out. This is from the conference board number. I mean, this is a really important chart This one seems to be less impacted than UMISH, but you still have a big drop off in vacation, which is a big part of the economy now in terms of what's going on. I think vacation spending has now surpassed auto spending on an annual basis. So when you see that kind of collapse, it is an important thing. And then, as I highlighted last week, FactSet, this is a big drop off in the EPS forecast. You basically have no growth, or you have negative growth for the first half of the year. Now, they still have it coming back quickly, and that's one of the important things is I think the market is still figuring when we get the tariff details that we can have a bounce. And I happen to believe this is a stall, and that's why I said I'm going to keep going through this. They're just, in my mind, there can't be a recession for the reasons I've mentioned in the past. We're not going to lose 1.5% of employment or 2 million people in jobs because of tariffs, and then them not be able to get jobs for a couple of years. That's just not going to happen. We have a labor shortage that's there, and we have an economy which is driven more by the technology and the service side, which just means it's less cyclical. So it would have to be a huge thing where people really lose jobs. And although you can always have a situation like that, if it did happen, I think it would be like 2020, and we'd have to print tons of money and get going again and have the economy going within a short amount of time because structurally everything's fine. In terms of tariff announcements, from earnings calls, it's huge, and it's not just one sector. So just to show companies, this is percentage of companies in each industry. I mean, this is across the board. So if anyone thought this wasn't going to have an impact, it has absolutely had an impact. And when you start seeing signs like this, so first of all, in terms of the correction, it was the 7th fastest 10% slump on record, and that's going back to 1929. So it's literally created a big fall, and it's led to 401k investors are trading most in 4+ years in pursuit of safety. This is how we're going to a panic stage, and I'm just going to show JC Perez. He put this. I got the same calls, and I know lots of other people that got the same calls. My mom didn't call, and the person who I use as kind of the person who always calls in this didn't call, but other people did call and said, how much should they sell out of the market to deal with what's going on? This is my favorite bull-bear spread. It can hang, as you see, for long levels of time, up at good levels. It can sit up here, and the bull market can continue. But this is a massive drop-off in the II bull-bear spread. I showed last week Ned Davis, which is one I like. That's there. AAII. Everybody's now in that side, and that's why we'll go through kind of where we are in terms of the possible bounce. Hedge funds continued. They started getting, there was news out in terms of how big the losses were. I talked about this last week. The de-risking, historic. I mean, you're talking about big ones here and times where we had them in the past. These were big market neutral events. I did a webinar for 22V. If you guys are interested in seeing the work I'm doing during the week and some of the deep dive stuff, I'll remind you, just go to 22V. They're an institutional research place. You can reach out on the website there. Just go through some of the factors again to show how the recession is being built in. This is the 3-month earnings revision. Just a complete collapse down. The S&P has not gone down as much, which to me is why this has been an unwind in a lot of levered hedge fund positions that were positioned for growth. It ended up being a shock in terms of the growth side. And so you've got 3-month revisions. So think of companies like Palantir and even the Mag 7, the ones that have had good earnings and still have their revisions that have gone higher. I showed last week NVIDIA. Those are the ones that have been hit the hardest. And that just shows you that this was people taking off leverage in position. So as of right now, it's a rotation. It's not a recession. And I'll go through some of the other places why. Equal weight consumer discretionary versus staples. I put all these lines in here because it has been leading. And it led here. We had a divergence. We had a divergence here at the bottom. This is what you want to look out for, in my opinion, because at some point people will get comfortable that there's not a recession and that this is a slowdown, and they'll start to put consumer discretionary back on. I think that's when the market will already be in an upswing. I actually think the S&P is going to bottom before, but I would just pay attention to that if we do have another leg down. We started to impact the global stuff too. So this is the 3-month revisions factor, but this is for the globe, and this is MSCI World x the US. So we finally started to see MSCI World x the US. This had been a rotation out. We started to hit a different point last week. That's a little danger position. So you're going to want to see more stability in the market this week. If we make another few days, we're going to retest, I'm sure, because I don't think the tariff news is going away until he's done with the negotiations. So there's going to be a lid on the market. So we'll get a bounce. At some point, we'll fail, and then we'll head back down, I'm sure. And whether we take out the lows is going to be dependent on that earnings revision and seeing weakness in things like the DAX, in Chinese stocks, places where it's been hidden so far. If that occurs, that would be when I think we'd see a different type of fall off, a bigger move in the S&P. We also have another issue here. I created an index of the private equity companies. This is the 6 big listed public private equity companies. So they've fallen sharply. This orange line here is what I use as a proxy for the lowest level of credit. So this is actually triple C's relative to high yield, inverted. This is the return, total return. So it's starting to break down. So it had been hanging out, and now all of a sudden it is breaking down. I only worry about this if they take this too far and it spreads into the private credit markets. We've had a big, obviously fundraising in private debt. I don't think we're going to get to that point. But if we did get there, it would show up through those things going down and make it harder for refinancing. We did have some high yield deals canceled this week. So we have started to impact credit. It's just beginning. I think if there's another leg lower, credit will be the main thing to watch. And I think that's where the Fed and the government would start to become a little bit alarmed. And I believe there's a Trump put. I think it's further down in terms of the equity market, but the credit market could go first. This is the Mag 7. We hit a 20% correction. So again, we're in territory here where you've gone down far enough on companies that are not having the same thing they ran into this year where they had negative earnings. So you've come down sharply on the Mag 7. From an RSI basis, we hit the lowest level since 19. So I'm going to start going through some oversold charts because I think the bounce that happened should continue for a little while, or at least some consolidation down here. Today was the first time that all 4 major index ETFs, daily ASR trading below 37 since the lows on September 22nd. So another oversold indicator. We did hit is how far outside the Bollinger Band we are. So we're below the bottom end of the Bollinger Band. So we had been down around here, kind of equivalent to this one and somewhere in. So we reached kind of panic levels or oversold levels on that. The equity consumer or equal weight consumer discretionary versus staples was actually the most oversold on a 15-day basis, except for COVID. So we had enough liquidations there, and breadth continues to hang in there. So I showed this last week. I'm going to show it again. This is why right now this is just a rotation. Breadth came down. Yes, finally it started to come. But then it bounced back, and this was actually the best breadth day of the year, and it was bigger than any negative breadth day. So breadth is still good, meaning stocks, it's still a rotation at this point. The headline index is down, but it's still a rotation. This is another way you see it's just a rotation at this point. This is the percentage of S&P 500 companies that are below the 200-day moving average. Above the 200-day moving average. We're still at 41%. When we've made important bottoms in here, we've actually gotten down towards the 20% level. So this is why I think you have to be cognizant that another low seems like a high probability just based on the uncertainty over the tariffs and the fact that we're not going to get anything there. I do believe if I had to pick a range, if you take from down 10% off the highs, I think you could take a correction down to 15 in the S&P, which would mean another 5% off the correction. Maybe it can be down 15% at some point during the year. And this is what I wanted to show. These are the yearly numbers for the S&P. So if you start with, there's not going to be a recession. Well, there wasn't a recession here, but we did have 2 quarters of negative GDP. But this was also when the Fed raised rates dramatically. This is 2018. This is kind of the one scenario that I guess I could see. This was the dot-com bubble. But aside from that, you pretty much have to have a recession to have a fall. that gets you to 10%, which would be another 5 down. So I'm leaning towards the fact, since I said there won't be a recession, the government can't afford it, and we're not seeing signs of it. But I do think stocks, they still want stocks to go lower, and I'll go through the reasons why. And that means it's very difficult to fight against what they want other than the earnings and looking at this. But when you have earnings estimates going down and you're seeing signs of slowing in the economy, you have to think that'll show up in earnings for Q1. And I think that's when we'll start to realize this. So for the next month or two, unless there's a dramatic shift and you start getting some changes, I don't think they want it to go higher. So we'll see what happens. Claims, the 4-week moving average is still in the middle of, this is nothing. I mean, there's nothing showing up. You're going to see people laid off, and this includes any federal workers who would have, but remember, they're getting paid through September, so this is the way they're staggering this so it doesn't have an impact. I just wanted to highlight the one-year inflation expectations. I mean, this is just amazing. Democrats, 6.5%, Republicans, almost zero. Which means almost everyone put zero. So these numbers are completely useless when you look and you see the headlines. Highest inflation expectations for 1 year in the history of the survey. You can just go through. The sentiment is the exact same thing. Republicans 83%, or 83 is the number, 41. So you really can't use the data. One thing that did go on this week with the inflation data, it was better than expected for the headline CPI. The PCE core is now estimated to be higher when that release comes out. So the CPI itself continues to move lower. And again, this is the Atlanta Fed sticky 12-month. It continues to point straight down. And the most recent reading for the month is below this. So inflation is gradually and continually going that way. And you have truflation, which is down here. And this is a relevant number. I wouldn't sit there and say that this doesn't have some reality to it. It is an overlay over the course of time, and I'd say I'd probably rather use that type of index, but you got to use the government ones because that's what the market follows. But the Truflation Index is down low, and I think you have to keep that in mind, because if the government is successful at slowing nominal GDP, which is what they're trying to do, down to say 4%, but inflation comes down a little bit more than what people expected, or we don't get the inflation that people are betting on at this point in terms of the market, you can have GDP hang around a little bit higher levels than maybe everyone's expecting at this point, because nominal GDP coming down to 4 from 5 is not going to be a recession. Egg prices, I showed when they had gone up. Well, they've come down sharply, so what the government did has worked at this point. Okay, they want the market down. They've had this huge correction. They got it back to where it was on September 12th. We had been hearing in the market and every podcast with a macro person saying that Besson and Trump and everyone was targeting 10-year rates to go lower, and we heard about this great move from here to here. Great. It's down 50 basis points. I hear everyone talking about how successful it's been. Well, back in September 12th, we were at 370. So something is keeping rates from falling if the stock market has round tripped all the way back. We've seen the city surprise index come down. We've seen people worried about a recession, and we haven't got rates down. And the reason is because what has happened with the tariffs, part of the offshoot is China and Germany are spending money, spending money, and at the same time you have Japanese yields going higher. So yields around the globe are actually moving higher, and that's keeping U.S. yields from coming all the way back down, because they all go together. So unless you're going to get a recession, if we're going to have 2% growth, I don't think 10-year rates are going to be able to make it down there. I don't know how they're going to be able to get it to where they want. I'm going to shift this a little bit. Ray Dalio spoke last week or 2 weeks ago on a panel in Singapore, I believe. But he made this comment. I'm sorry, this was in an interview that I would listen to on Odd Lots, Bloomberg Odd Lots. You can go listen to this with Tracy Alloway and Joe. It's good. I listened to it because I spent a lot of time with Ray Dalio stuff this week, and I'll go through the reasons why. But he warned about how they have about 3 years to get this in check. And I'm going to go through the reason why. Bank of America put something out basically saying the same thing. And this is what I want to emphasize to everyone who doesn't believe in what the government's doing or think this is just being done recklessly. We need to do something now. There's a reason why now, and we can't kick the can down the road right now. We have to do something to get the deficits in check. We have to do something to keep this from spiraling. And the government really only has this period of time to be able to do this. So the question is, what are they actually doing? And this is why I'm going to go through the Ray Dalio stuff. But growth has been enabled by unsustainable government support. Absolutely true. It may take time for private sector job growth to accelerate, for government works, blah, blah, blah. This was a Bank of America putting out that it's worth doing this. And they just highlighted that we're very dependent on the government. We have been. So we have to start moving away from bigger government, more towards the private sector, which is what the administration is trying to do. Now, Stephen Miran, who's part of the national, he's part of the administration in the National Economic Committee. So I would go read. This is my Substack. I did a whole thing on where the Trump put is. He talks, and he wrote a paper back in November that has laid out pretty much what the administration is doing when it comes to the tariff side and other sides, but he also brings in there that you have to be careful of the markets. And I think that's what we're getting to now, is that in Ray Dalio's interview on the All In podcast, which was late January 28th, you can go in there, and I think he does a great job, like he did on the Odd Lots, of explaining the history of the scenario that the U.S. is in and why they have to do this, or within 3 years, in his opinion. Think of it as, we're going to have an auction that fails. And that's worse for the economy than trying to quickly get us back to 3% of GDP. So he wants the deficit to go from 7-ish back to 3. That number may sound familiar, because that's exactly what Scott Bessent is calling for. And when you go through the Ray Dalio side, which I'll keep going, Bessent's 333 is related to getting the deficit down to 3, keeping real GDP at 3%. How to get this and this, how do you do that? Well, Ray Dalio goes through that. And one of the things also is to pump out 3 million barrels of oil a day. And this is the way he writes about it. It's called a beautiful deleveraging. 4 levers are moved in a balanced way. So the printing of money and debt monetization, think of it as, okay, stimulative, the stimulation, which in this case will be printing money in terms of tax cuts, but other ways that we're going through to offset the deflationary deleveraging forces, to bring nominal growth rate above the nominal interest rate. So you're trying to bring down rates at the same time as keeping growth up there. You got to do it without getting inflation high. And this is the threading of the needle that is very, very difficult. It's one of the reasons why the currency devaluing at the same time that rates are going down is a positive. But he says specifically, you have to do this when the economy is good, and the stock market going down is a very dangerous thing. The stock market going down will hurt the revenue side, but it will also hurt the real GDP side. And this is why when you go through it, they're trying to navigate this thing with a short, sharp kind of trade negotiation side, at the same time as getting their tax cuts through, which is some of the stuff that went on with the shutdown, and making sure that they get that in at the same time by July. So that's why they don't want to bounce in the stock market at this point, because it makes everything more difficult to negotiate with the rest of the world. He actually wants things to be in a position where he can negotiate. So I have full confidence that if we try to get this to 3%, which is what their goal is, the question is, can it be done in 1 year? No, it can't be, not in my opinion. Can it be done over the course of 4 years? Yeah, but they have to get started. And that's one of the things that Ray Dalio said, is you have to get started on this immediately, because it takes time to get this through. And this is where the issue becomes, as we've shown this before. The debt is large, and here's the problem. When you have a deficit of 7%, you're funding it with more debt. And so at 7% of GDP, you're running into this problem, which is this year we have debt maturing or needing to be refinanced of $9.2 trillion. You can see this outsized amount. And this is because we're stuck in a situation where most of our debt is short term. So we have $9 trillion, which is equivalent to 33% of GDP, plus the 7% deficit would mean basically we've got a huge, huge problem, a 40% of GDP of debt that we have to deal with. So they are going to try to move levers. They are going to try to renegotiate and get whatever they can out of this, including Doge. And if Doge is $100 billion, it all counts. At this point, they're trying everything they can to offset it and start going in the right direction. And so I think you have to be cognizant that they can't have the equity market go down a lot, but these structural one-time issues, they have to keep going. And that's why they're going aggressively on the austerity side at the same time, which again, this is what Ray Dalio put out, on the side of stimulating. In terms of the approval ratings, which makes it difficult, they're all getting down there. I mean, this is a recent survey from U.S. News. And again, on every single thing, but you can see in particular the trade issues with Mexico and Canada are down here. The trade issue with China is up here. People don't have a problem with it. Immigration, they're on the same page. It's really mainly in this part. And so that's why I think the trade side has gotten, it's become difficult. Okay, they went through, no shutdown. If you go read the details as to why, this has a lot of maneuvering, but this is to avoid having the Republicans have free reign of closing agencies and doing stuff while the government is shut down. It'll be easier for them to do stuff. I thought this was interesting, and I'll tell you why, but lots of talk in Trump circles about the need for some grand plan to resolve the tariff issues with Mexico, Canada, and Europe as a one universal settlement. Now, again, he put this out at 6:15 on Thursday, and then only less than an hour later, a person close to Trump White House tells me the following: unfortunately, this is not being discussed at this time. The one thing that is absolutely happening, and Anthony Pompliano and I talked that on our weekly this week, is they are very coordinated at the White House right now. They are negotiating things, and everyone's on the same page, which is you do not talk about the negotiations. Think about this as any sports negotiation that's going on between the team and talent. They are trying to negotiate deals to get something over here in terms of investment to make the deficit situation get better. And until that is done, you're going to just continue to hear negative sentiment coming out. And if anyone goes at them in terms of the countries, you're going to see him respond the way he did with Europe this week, the way he did with Canada last week. I think that's going to be the plan. One thing happening, Vietnam coming to the U.S., and I think there's an off-ramp here. And Vietnam is important because they are, I believe, the third biggest net trade partner with us in terms of a deficit for us. A lot of that is China has moved things to Vietnam. So I would just watch this because they have come to negotiate, and that one has been a little bit more of what I would say is an off-ramp. And then you had this come out after Europe basically spoke out. Trump said he was going to go to 200% on alcohol. And then all of a sudden, Howard Lutnick, and this is from the ambassador, from the trade person in Europe, or the ambassador. A lot of work ahead, but let's stay focused and explore the best ways to move forward in the right direction. So immediately you get negative comments, and I think everyone is realizing that this administration is not going to back down, and they wanted to get to that point. And so there's still anyone who is not backing down. They're basically speaking out on a regular basis. I mean, it's hard not to see Lutnick and Besson on TV every single day. So this is just going to continue, but I think we're getting clearer signs that they want to renegotiate this, get the tariffs in a situation where they can get some money back from the private sector. I do view this as a consumer tax, but since most of the spending in the U.S. is from the higher end, it is almost a consumption tax. So we'll see what negotiations come out, but I do think they're trying to get the money from there. This is the positive thing that's going on, and I think this is very, very important. So I am doing a lot of deep research work for 22V. This is the reason why I joined them. For those of you interested in getting that, I will be doing this on AI in particular. Right now, it's focused on full self-driving, AI agents, and robotics as the next phase. And one of the things that's really important for that is memory chips. So we're seeing DRAM prices finally start to make this fast move higher. And this is really important because remember, we started peaking in NVIDIA kind of in here, and this is when semis started to get weak. So DRAM, which was expected to go higher, so the memory side was expected. What hadn't gone higher yet was NAND, But now you've got NAND prices on this are starting to show up, and they're talking specifically about these companies benefit the most: Micron, SanDisk, Samsung, and SK Hynix. NAND market seems to finally be seeing a turnaround according to Commercial Times and Tech News. U.S. memory makers like Micron, they are set to raise NAND prices over 10% beginning April 1. So this is important. Now, you know how I love to look at markets. My favorite stock for this year is Micron in terms of the one that should benefit the most. This is year to date now. So this is as for December 31. This is all these names that were just mentioned: SanDisk, Micron, SK Hynix, and Samsung. Those are the four that were mentioned in that article. They are all up year to date. Semiconductors, this is a SOX. It's down 7% year to date through Friday. So Samsung is the least performer at 2, but you look at these, you've got the other ones up at least 19 to 20. This is a growing story, people. This is important for robotics. This is inference. This is everything on the AI side. So anyone looking and forgetting that AI is not a bubble, this continues to grow. This chart is saying it, and here is SOX over the NDX. So this is what you want to start to watch. This is overlaid with those two charts. So again, NAND, still here, but they're talking about a 10% price increase, which would only put you here. But again, this would be the first increase since basically the semiconductors have peaked. So the semis peaked here, NAND stopped going up here. Well, now you've got NAND going up. You've already got DRAM going up. This looks like a really important story to me. This is the overlay of the SOX with the NAND market, so what I basically just showed. So that's not the relative, but that was versus the SOX. You're oversold in the SOX. Almost everyone I hear from a technical basis is super bearish on it. Semis are the commodities. They represent the AI future. You want to follow what the charts are doing on the structural bull thing. And right now, the semis look like they're making a bottom here. Semis have not been part of 12-month momentum. So everyone calling up going, this is going to be a reversal of 12. They're down over the last 12 months. Semis have not performed, so they've been leaving gradually the momentum trade. The momentum trade has been more about the analytics, the software companies, things like that. So I don't think this is a bounce in Mo. In terms of the importance of the semis, if the white line is going to start going up, well, this is the Mag 7, which has taken us back to where we were. So all the outperformance that happened, these guys are all resetting from a point which is very, very similar. So just keep that in mind. And if you're looking for how NVIDIA did last week, well, NVIDIA has surpassed where it was after DeepSeek. And then after the earnings, when it collapsed, we closed above both of those panic prices. I love seeing charts like that where you start seeing the move. Natural gas, the power situation, which I continue to say is going to be a major story in the second half of the year. Despite everything happening in recession fears, here's the 10th contract of natty gas. Looks fairly parabolic to me. And if you don't want to look at natty gas, look at another place where power matters, and that's copper. This is the 6-month contract of copper. If we were in a recession, Dr. Copper would go down, absolutely would go down. The AI build out is happening. That is a massive build. It's a massive spend, and we're at highs since, we're making 4-year highs right now in copper. So you have some commodities going down on the energy side, which is good in terms of oil and gas at the pump. But then you have the other side. This is what I talked about in terms of the spending, and this gets important. Remember, if you're trying to cause a recession to get your balance sheet in check, but at the same time you're saying you need to win the AI race with China, well, China's spending more money. So China continues to, they're going to make an announcement on Monday. The stocks were up big on Friday because they're going to be spending more money. China orders major boost to defense spending. China released a new AI agent tool this week, which, again, is another one, another expansion in terms of just showing how they've had a ton of these. But there's no doubt right now that we are in a neck-and-neck race. So you can't be putting the economy into a recession the same way China right now is trying to speed up their economy because we're in a trade war with the U.S., and so they're boosting their development of AI. This is what makes this whole thing ridiculous for people who think the government's going to put us into a recession. That's not what's happening. We need to get the deficit in check. I'll say this again. There is no recession coming in the United States. Who's winning the humanoid robot race? Well, this is a big one too. So this one is neck and neck. Every week there's more humanoid robot stories coming out. This is on the U.S. put out that they've got ones lower. Unitree had one. You've got humanoid robots. And again, I put these out so you can go watch the videos too. If you haven't watched the videos on them, You really should, to see the advancements and just where things stand. This is real. This is coming. You cannot be bearish. Productivity and stocks 3 years from now. So focus on the tariffs for right now, but by the end of the year, I think the S&P will be up on the year, and I think it will be driven by a lot of the euphoria that's coming on this. The robotics story is real, and again, robotics and all that fits into those charts I showed on DRAM. This is a very different stage. This is not the LLM stage. This is the moving AI into hardware stage, which also is going to be on the phone, in cars, and in robots. So you just have to get ready for the fact that this is a different part of the expansion. I'm sure there's the Abundance Summit was last week, and I listen to this every single year. It's my favorite thing. But just remember, this is what's happening in the world. This is the story that's going on. You can't get caught in the tariffs. That is living in the 1800s. I'm telling you, it will only lose you money to sit there and worry about the tariffs and go through it. That is not the end game. The deficit is a problem, but we are going to print money at the end because we're not going to be able to get the deficit completely in check. And so you're going to continue to have it. When this turns, Bitcoin will obviously be going higher, but Bitcoin is being driven by two components. They are not going to do as much as what they're saying, so the recession is not going to happen. Whether we made a low in Bitcoin or not, we'll leave that in. But I just want to remind you, I am doing a weekly with Anthony Pompliano. And again, the reason for this is we both believe that the macro is now feeding into crypto. If you do not focus on Bitcoin being the #1 AI trade, at the end of the year, you will be looking back realizing that it's really hard to invest in a large index of AI. The last 2 years, you've been able to invest in AI through the Mag 7, which are mega cap names. At the end of this year, the second biggest market cap in the world, in my opinion, will be Bitcoin, bigger than all of the Mag 7. And so that's what you're going to get into. That's what I thought this was year is about. Tune in to Pomp and I to go to at least hear some of these things, because he has got a lot of information on that side, and I think we complement each other well in terms of the macro. I highlighted this last week. The chart is starting to look better and better. Of course, it's possible we can make another low down here. It would take the equity market to do that, but since we have NVIDIA going higher, I would really pay attention to this pattern that has happened at all these levels. Remember to stick and just continue to be ready for when it turns. Here's the NVIDIA chart with Bitcoin. It's been related. There's no way around it. I don't think NVIDIA can go up dramatically because I do think the valuation side will become an issue. But I think NVIDIA still remains a very, very important stock and the one that will be most related to Bitcoin. And I just wanted to highlight this to finish off. Every single person talking about MicroStrategy and how it's a bubble and all this stuff. 23 returns, 350%. 24 returns from MicroStrategy, 350%. With the market down and collapse going on and Bitcoin down for the year, MicroStrategy finished Friday up 2.7% year to date. So go find your other bearish thing. I'm a buyer of MicroStrategy. I believe it has a moat, in the only moat that exists in the future of the digital economy. I'll leave it there, and I'll see you guys next week.